welcome everybody to another webinar here for IDC. I'm delighted to welcome Hilda and Angelina to present to us today on behalf of IA. My name is Graeme Allan. Many of you know me, along with myself and my colleague Alex Chan at West. We're really happy to kick the year off, and obviously a very topical subject, RRSP season. It's that time of year when people actually start to think about their savings again, when the statements have come in, whether they're up or down. People are actually talking about money and obviously looking for the tax advantages of getting into the RRSP program. We've had a difficult year. Last year was not the best, obviously, in the markets, but very much so a time of opportunity. Some of our more successful advisors are the ones that say this is the time when they pick up the most clients, that those advisors that haven't been speaking to their clients have not engaged, they've not kept up to date as far as keeping people apprised of what's been going on with their portfolios. This is the time when they actually actively get some of those assets and bring on board. So a great excuse to speak to people. Statements have gone out. It's just easy now for people to be putting the money into their programs for the year, and who better to do it with than IA. So I'm going to hand it over to Hilda, and we look forward to the next 50 minutes or so of our presentation. Hilda, over to you.
Perfect. Thank you so much, Graeme. And okay, is everyone okay with my screen? Just want to make sure. Perfect. So good morning and good afternoon, everyone, depending on where you are. And I just want to do a very brief introduction for myself. So my name is Hilda. I'm the sales director in BC. And I also have my inside sales online here as well. And I'm sure like those of you in BC must have talked to Barbara Vaughn before. So both myself and Barbara look after IDC, and we work very, very closely with Alex Chan in here as well. So, just according to what Graeme has just said, last year was definitely a very difficult year for everyone. So what I'm going to do in this presentation here is that I wanted to spend maybe 15 minutes to talk about, the markets, talk about what happened in 2022 and the outlook for 2023. So after that, I also wanted to talk about some of the portfolio recommendations as well, because at IA, I'm actually involved in a committee where we set up portfolio recommendations for our advisors, because I know that sometimes it's very difficult. When you take a look of our fund code booklet, there are like easily 130 funds on there. So which are the funds that you should be focusing on this year based on the market outlook? That is the recommendations that I wanted to, share with everyone today. So first of all, I wanted to introduce IA to everyone. And I'm sure IA is no stranger, to most of our advisors online. But I do wanted to, talk about we are actually number one in many different areas. So we are number one in compensation program, which Angelina will talk about of our compensation schedule, because we do pay the highest in the industry. We are also number one in website quality. So for those of you who are, using our Evo, using our online My Clients space where you can get the statements for your clients anytime you want, 24/7, you would know that our website quality is very user-friendly. We are also number one in digital experience as well. So back in like 3 years ago, when the pandemic started, we launched Evo just in time for the pandemic. And now people love dealing with IA because it's just so easy to open applications with us. If you wanted to open an RRSP application, it's just going to be 8 minutes, then you're done. So not only we are number one in all 3 different client experience, we are also number one in net sales in segregated fund. So ever since 2016, we are number one until like every year consecutively, this year as well, including this year. So there are many reasons why we're number one in this space. Well, I will talk about the fund choices. Well, that is really one of our sweet spots because we have a lot of good third-party managers, more options for your clients to choose from, and which will also have a very good compensation schedule, which Angelina will talk about as well. So I will leave it for Angelina to talk about that. Also, our company is a growing insurance company. And I remember when I first started with IA, which was 7 years ago. Wow, time flies. 7 years ago, when I first joined, the stock price was hovering around $60 per share. And now our IA stocks is trading more than $80 a share. So we are definitely a company that we are growing tremendously. So that's it about introducing IA. I just wanted to talk a bit about what happened in 2022. Just like what Graeme has mentioned in the beginning of the presentation, if you take a look of your client's portfolio, unfortunately, most of the portfolio were down. And in no surprise, this is the returns for last year. So as you can see that all of the major indexes are all in red, unfortunately. So let's take a look of the fixed income space first. It is very rare to have 2 consecutive years of negative return on the bonds side. And well, the reason why we know, because of the inflation and because of the Bank of Canada and the Fed keep increasing the interest rate in a very rapid pace. And that caused the fixed income not performing last year, especially if you're in government bonds. And there's also always a correlation between bonds and the interest rate movement. As the interest rate increase rapidly, you will see the bond price also drop as well. So that's where you see the bonds is not performing last year. It doesn't matter if you're in corporate bond or in short-term bonds. But as you can see here as well, the long-term bond tend to suffer more than your universe. And your corporate bond tends to suffer less because the corporate bonds usually are not tied with interest rate movement, because usually corporate bonds are tied to the credit rating of the corporations. So looking forward this year, bond should perform. There is no guarantee, but if the interest rates stop increasing in a very fast pace, then we'll see bond coming back. So we do have some very good recommendation on the bond portfolio for you later. So that's the bonds. Let's take a look of equities. Well, you could see that anyone who owned our US stack, which also mirrors the NASDAQ, dropped the most last year. So technology sector was not performing at all last year. And if you remember 2021, the year was great, especially in NASDAQ. And when you got into the NASDAQ space or the IT sector, you're actually buying very expensive stocks because the NASDAQ was just overpriced, seriously. Last year was actually a very good timing to get back into the NASDAQ or IT sector because, it dropped and the price earning ratio adjust. So I would definitely say that this year, it might be a good time to get back into, U.S. equities. However, if you ask me, or, I've been to a lot of portfolio managers webinar, Canadian equities are still looking very attractive. So when you take a look of last year S&P TSX, the return, it was minus 5.84. So technically, the Canadian equities index have not gone into a bear market. So what defines a bear market is anywhere, a drop anywhere 20% or more. So with S&P TSX, it was not in bear market last year. So that's why if you hear me talk in any training sessions, I always recommend, doing more exposure in the Canadian equity space. And looking forward this year, like I mentioned, Canadian equities are still going to look attractive. U.S. equity is very hard to say because we are going into earnings seasons right now. The market is very anxious to see what the earnings of the S&P 500 corporations will come up with. So we had some bad earnings 2 weeks ago, and that's where you see some volatility in the market. And now we're waiting for earnings for Amazon, for Alphabet, for those Meta, all those big IT company earnings coming out. So the earnings of big corporations really dictate what we will see in Q3 and Q4. And I was in a Fidelity webinar yesterday morning. They were expecting that the S&P 500 had bottomed out already. But of course, this is just like the expectation. So it doesn't mean that the S&P 500 will experience a bull market right after. No, none of that. It might stay in this level, but it shouldn't be worse than last year was the consensus. So some of the things to keep an eye on is really on emerging markets and international markets. So for the last 2 years, international and emerging market performed poorly, but especially with the war in Ukraine, that affected international market more, and especially with US dollar strengthening as well. So this year, a lot of people are expecting that the US dollar will weaken. And that is good news for international and emerging market because they always go opposite direction. If the US dollar weaken, you will see that international and emerging market pick up. So if you don't already have some of the exposure in your portfolio, maybe this is the time you might want to think about that. Good valuation as well. Okay, so let's go to this slide here, S&P 500 historical return. So many investors are likely wondering what history says about returns after down years. So encouragingly enough, history shows that 2 consecutive years of losses are quite rare for the S&P 500. It had happened before, but since 1928, the index has only posted a negative total annual return for 2 straight years, 8 times since 1928. And these successive years of losses occurred during major world events, such as the Great Depression, World War II, the bursting of the dot-com valuation bubble. Okay, so more broadly, in the year after negative returns, the S&P 500 has advanced 12.6% on average and is positive 68% of the time. So this is encouraging news. So when you take a look of interest rate movement as well, Bank of Canada just increased 25 basis point of rate hike not too long ago, just last week. And we don't know if this will be the last one because when you take a look of inflation number, normal inflation number should be around the 2.5 figure, okay? So right now, 2023, Q1 is still hovering around 5.4. So we still have inflation problem. So it really depends on, the interest rate has been increasing rapidly. That cool downs a little bit, but we still have, some gap between the 5.4 to 2.6 here. So the Fed is gearing up for the January meeting scheduled for today and tomorrow to decide if there will be, any change in the pace of rising interest rate. So after numerous half points increases, Wall Street is hoping that recent economic reports, which suggest that inflation is easing, will prompt the Fed to raise rates by just maybe 0.25%. So if that is indeed what happened, it could signal to investor that there is a light at the end of the tunnel. So it really depends on what happened with the interest rate. Then we'll have a better, clearer picture on Q3 and Q4 going forward. So this is just to show you the index return for this week. And as you can see here, that January was actually a good year for the markets, and most of the indexes, in fact, all of the indexes has bounced back to positive area. So that's it about my little market update here. And in the beginning of my presentation, I did mention that our sweet spot is our third-party managers offering. We partner up with Fidelity, with Dynamic Funds, with BlackRock. So our advisors have more access to different type of funds available. So we have different portfolio recommendations for our advisors. And we have set up 5 different portfolio recommendations from prudent all the way to aggressive. And you notice that basically all 5 portfolios, we're actually talking about the same fund, but it's just the asset allocation, the percentage allocated to each fund is different depending on the risk profile. So I will talk about these portfolio recommendations and then explain the logic behind why we choose certain fund on the portfolio. And I know that Angelina will also talk about, Indexia, our index fund or one-stop shop type of hands-off investment approach with you later on in the presentation. So let's get started. Well, I mentioned about fixed income earlier in my presentation. Fixed income is more complicated than equities, like I think, because it is so hard to gauge when is the time to get back to a long duration bond and when to get out from long duration to a short duration. So when the interest rate were rising for the past year, what most managers have done is they switched their bond funds to short duration, because shorter duration tends to have less sensitivity to interest rate movement. So for regular people or retail clients, it is very hard to decide when is a good time to get back into the government bonds space, right? Or when is the time to get to floating rate. So that's why we have created a portfolio called Fixed Income Managed Portfolio, because we outsource that investment expertise to our manager. So inside this Fixed Income Managed Portfolio, we have about 4 or 5 different bonds in there. So you will see our strategic corporate bonds in there. You will see our short-term bond and then floating rate, and also PIMCO, our global monthly bonds in there as well. So based on a 6 months forward-looking market outlook, that's how the portfolio manager is deciding which bond exposure is going to be involved with this fixed income managed portfolio. So I highly recommend that if you are looking for a fixed income solution, use the fixed income managed portfolio. Okay. So I also mentioned about Canadian equities being very attractive still. We've been talking about dividend growth fund for quite some time now, and it's managed by our own manager, Donnie Moss. With dividend growth, its mandate is on, large cap, blue chips company that, keep growing their dividend. So top quality, like high quality dividend paying funds are always good option, especially in a recessionary period, because these type of companies tend to be more stable than your regular small to mid cap company. So that's why we've been introducing or talk about the dividend growth fund. So when you take a look of the top holdings, the top sectors in this fund is mostly on energy, on financials, and materials. So these are the 3 top sectors that in S&P TSX. And this will be a very good option for those clients who are looking for a dividend fund. So 100% is mostly in Canadian equities. So the next option that you have in Canadian equity is Fidelity Canadian Opportunities. So you notice that we only have 5% dedicated in this fund here. Well, the reason why is because this fund is tailored more so to your small to mid cap company. Very different approach than your dividend growth, because with Fidelity Canadian Opportunities, the manager is a contrarian. So he goes somewhere that people are, afraid to go to. So if you take a look of the sectors that he owns in this fund, you don't see energy, you don't see really financial as well. You see mostly of consumer discretionary or even information technology. This is where the manager is finding opportunities in the Canadian equity space. So this is a very good diversification in Canadian equities if you already own dividend growth. So we highly recommend this fund, and the track record is also very good as well. So the next fund that I wanted to talk about is the Global Dividend Dynamic Funds. This is one of the funds that most advisors who use IA have heard of, or, everyone knows David Fingal. He is, a very capable manager. Even though the funds has not been underperformed last 2 years, but there are 2 reasons why that the fund did not perform. Well, the first reason was last year, almost none of the global funds was in a positive area, because if you think that the war and the Ukraine war affected the global economy, and it actually affected the international and emerging market more so than your North American counterpart. So any global funds, you will see about 50% in US, the rest will be in international and emerging market. So that's why the global dividend, was not performing last year. That's one of the reasons. The second reason was because David Fingal is a very, his management style is very highly concentrated, meaning that normally you will see about 200 holdings in a single fund. With global dividend, you only see 30, maximum 30 companies in there. So I remember that last year he was still very heavy on information technology. So that's That's why the fund was not performing. But if you are comparing his peers, global dividend type of fund with other companies, he's still outperforming his peers. So he is a very good and capable manager that gives our clients risk-adjusted rate of return, okay? Because he does tend to give a high return with less risk that he's taking. So I really like David Finkel as a manager. So the next fund that I want to talk about briefly is the Global Equity Opportunistic Value. So this is managed by Loomis Sayles, and this fund is basically go anywhere, go any style. So this is a very good diversification, on top of all the funds that I've just mentioned. So the last fund that I wanted to talk about is thematic innovation. So this is a theme-based mandate, meaning that it's U.S. equity, 100% U.S. equity, but its mandate is really on artificial intelligence, on clean energy, on what else? Artificial intelligence. I'll just mention about that. Biopharmaceutical. Yeah. So any new innovative idea, this manager will be, interested to invest the money into. So this is a very good complement to any, NASDAQ or like the US stack fund that you might have, or maybe it could be a very good complement to our US equity BlackRock, which is mirroring the S&P 500. So this gives it a little bit of different spin to your US equity holding. So that's it about the portfolio recommendations. I just wanted to go very quickly to give you an overview of what we have in terms of segregated fund series. Okay, we have 3 series, 75-75 and 75-100. Both series here, you can see the first 75 is actually our maturity guarantee, but our maturity guarantee doesn't happen until the person turns age 100. So we don't really promote the maturity guarantee in these 2 series here. So if your clients are really looking for maturity guarantee, 15 years of maturity guarantee, then you will be looking at a 100-100 EcoFlex series. I'm not going to spend too much time on your 100-100 series because not a lot of advisors are, buying into 100 series now because the management fee is higher and also the investment choices are much less. And with 100-100, you just need to remember that there is a 15 years of maturity guarantee because it really depends on the age of the clients when they sign up the contract. Then it determines the reset day. So it is more complicated. So if you do have a case, then please feel free to reach out to myself in BC, to Angelina in Toronto, and to Jess in Alberta. Okay, so let's focus a bit of our time on 75-75 and 75-100. The classic series 75-75 does not have any resets. So the management fee is the lowest for 75-75 because you're only getting a 75% of death benefit guarantee. So for 75-75, you also get prestige preferential pricing as well. And I believe that Angelina will also go through the preferential pricing with everyone, which is the threshold is 300,000, okay, household. And 75-100 is really our sweet spot as well, because with the 100% death benefit guarantee, it goes all the way past age 80 until the person turns age 85. And that also includes an annual reset as well. I don't believe that other insurance company will offer you a reset after the age 80. So this is a very unique offering that your client can still reset the contract before he or she turns age 85. So the reset is once per calendar year. And with the reset, you could do automatic or manual. So with automatic, we are, again, one of the leader in, innovation, because with the automatic resets, it's not on the anniversary date. You pick a date. We give you the flexibility to pick any date in the year. So I normally like to recommend advisors perhaps choose somewhere at the end of the year. The reason why is because you could also do a manual reset if the market is performing. So once you log into Advisor Center, go to My Client or go to Tools and Application at the very end, you will see 75-100 resets. When you click in there, you basically see all of your 75-100 contract. And you could also see there is a gap column that shows you the before and after reset percentage. So if you see that the percentage is big, let's say the market picks up and then, it's 20%. So you have the flexibility to reset the contract manually on the same day, bypassing the automatic date that you have set up later in the year. So just keep in mind that when you do your applications, it's not on the application form. You will have to wait until your contract has been set up. Then you will need to go into tools and application and set up a date for your reset afterwards. So both 75, 75 and 75, 100 qualify for Prestige again. And other things that I wanted to quickly touch on, how am I doing with time here? Okay, 10:26. Okay, all right. So just bear with me for a little bit more. I just want to briefly talk about For Life. So For Life series is our income for life, more like a life annuity concept. And I would only say that For Life is only good for older clients who are in the RRSP stage. Because as you all know, with RRSP, if you are experiencing a down market and you have to withdraw your minimum out, you are actually eating into your portfolio quicker than when you're withdrawing from an up market. So what For Life can offer is a steady income stream. So let's say for 71-year-old, I can't remember exactly what the For Life rate is, but it's over 5%. Let's say it's 5.5, okay? You deposit 500,000, we give you 5.5 out of that 500,000 throughout your lifetime until the person passes away. So the sweet spot is really on RRSP because at age 71, the rate is 5.5, let's say. And if the RRSP minimum keep increasing every year, IA has to pay the RRSP minimum, okay? Even if it's higher than 5.5. So in other words, your RRSP never runs out in this scenario. So the For Life basically is mostly invested in fixed income. So I would not recommend anyone to put the whole pot of money into For Life because it's not growing. You're just getting an income stream. So perhaps you can think about investing the fixed income in a For Life series for your RRSP and then leave the equity portion in a regular segregated fund. So this could be, a sales concept that we can all use. And pardon me, I just noticed that my HISA and DIF rate is 2.35, which is not true anymore because the rate keep increasing. So the HISA and DIF rate right now is 3.9. So with our high interest saving account, completely comes with estate planning features. You can bypass probate and you can also designate a beneficiary as well. Perfect for clients who want to park their money short term or, they're not sure about the market yet. They can park the money on HISA and then you can later on move the money out from the saving account into segregated fund and get paid. Okay. I believe that this is my last slide here. So I should pass it on to Angelina. Perfect. Angelina is my Ontario counterpart, and I'm going to pass it on to her now. Thank you, everyone.
Thanks very much, Hilda, for doing a lot of the heavy lifting. That was a very detailed presentation, folks, and I hope you got some key takeaways, especially with respect to the portfolios. I got a couple questions in the chat, and unfortunately, I wasn't able to address it in the chat. Don't worry. In our email that we're going to send after this webinar as a follow-up, we're definitely going to send you a copy of those portfolios, and your wholesalers in your, the region and the provinces that you belong to will definitely be able to send you those portfolios as well. Hilda, that was such a great slide. I don't know if everyone caught all of the information that was on the last slide, but we have such a huge product shelf. Definitely, every product or investment solution that's available to you this RRSP season. But of course, I'm here to talk about the RRSP campaign for this year. You folks are probably not unfamiliar with this slide. We kind of do this campaign year over year. We have a $5,000 draw. So any of your clients doing additional deposits into their RRSPs will be automatically entered to win a $5,000 draw It is a cash prize, and there is one prize across the country. So that is currently our campaign, and it also helps your clients be a little bit more familiarized with the My Client space, and it allows them to do transactions themselves from their online banking. I know that some advisors like to be very hands-on with their clients and have all, the resources available to their clients through them. But it is such a big help if especially for those last minute RRSP deposits at the end of the year, at the end of the contribution period. It's super, super helpful. And on that note, I think I wanted to mention as well in this RRSP campaign that why don't you tack on a TFSA campaign? The reason being is TFSA's limits now take you up to about $88,000 for contribution room. That is a lot of money. That's no longer, something not to talk about where, back in the day it was $6,000 and it kind of grew, but, not as much. But now it's definitely worth your time to discuss with your clients. For those clients that have maxed out their RRSP, have probably some, wiggle room to do a little bit, to contribute a little bit into their TFSA. Definitely something to bring up, especially if you're an advisor that's trying to plan their business. I'm going to talk about this a little later. If you're trying to plan your business to include investments, it's definitely, worth a conversation with your clients to see if they have utilized that TFSA contribution room. If you're trying to hit, as a personal production goal for yourself, $1 million in 1 year, that is something as easy as doing 12 TFSA plans for your clients that's maxed out at 88,000. So something to think about. Our objective this RRSP season is going to be stay the course. Hilda mentioned a lot of wonky things happened with the market last year. It was definitely an outlier year. She did a lot of the heavyweight lifting with respect to explaining, the differences between the equity markets and the fixed income markets. But I think the key message here, regardless if you understand the nuances of those, two universes, the key here is that your clients stay the course. I know lots of people were, fidgety in the last year and were accessing their accounts and doing some withdrawals. But, had they stayed fully invested, you would have had a nice bump. As Hilda was mentioning, we saw a nice bump in emerging markets as well as European equities this month. So definitely the key here is to continue to stay the course. And Hilda also mentioned that the S&P 5 typically doesn't have two back-to-back negative years. So if we take history as our guide here, we're hoping that it will be a positive year for the S&P 5. You're probably wondering where you can access these email templates. Everything is available to you in the Advisor Center under Documents. Under Documents, you can find, it's a little tough to find specific emails and marketing materials sometimes in our Document Center because just the SEO word search is kind of difficult. But if you put that word campaign, just put that single word campaign in the Document Center, all of our campaigns will come up. So our TFSA campaign, which follows our RRSP season, our RRSP campaign, if those are doing our ESP campaigns throughout the year, that's also available. Just type in that word campaign in the Document Center and you can access all of our campaigns, which looks like this. So this is what it would look like in an email. You can put your information there under Financial Security Advisor, how to enter, the deadline for entering, all of that. If you wanted to just pull a list of all your clients' emails, and you can flip this email, tailor it to suit yourself, and you can, go on with launching your RRSP campaign if you haven't. And of course, I wanted to take the opportunity to talk about TFSAs. I think this is what our TFSA campaign looks like. You can add your photo at the end. I've seen some advisors get creative, but your information, your photo there, and really just, time this. So right after RRSP season, any clients unaware, 88,000 is the maximum that they can add now into a TFSA. And that's all, it's not tax deferred. It's literally no capital gains on those investments within a TFSA. So super, super cool. And, finances, especially this year, as clients are a little bit more tuned in to inflation and what they're saving at the end of each month. I think it's a really easy time to talk about savings and investments. Regarding our RRSP campaign, we have recently launched RRSP loans on Evo. you're probably wondering, Evo super, there's always lots of updates to Evo. Even myself, I find it so hard to keep up with the updates. Where is that RRSP loan option on Evo? I get that question probably daily now since we launched it. So I just wanted to show you guys, here that under the contribution tabs in Evo, you see amount borrowed through RRSP loan. So that amount, so that is basically what you have to click on to take you into the RRSP loan. And I've done it virtually myself as well as with advisors, and end to end, it takes about 10 minutes. So much quicker than doing the paper RRSP loan. And obviously this is better use of your time because, you're doing the same amount of paperwork probably for $2,000, $3,000, $5,000, $10,000, which isn't very, very much, especially if you're doing a volume of transactions. So keep in mind, we now have RRSP loans housed within Evo under the contribution section. And finally, we are ending our campaign for 50 basis points off on interest on February the 10th. So keep that date in mind. February the 10th is the deadline to receive 50 basis points off of your interest rate for your RRSP loan. And this is something we do every year. So for those of CPB first year to fourth year qualifiers, I'm sure you guys are familiar with this. And I do see a couple names in the chat. And finally, resources for your clients. We have launched we are launching a TFSA calculator soon. There is an RRSP calculator. Hopefully you folks do take advantage of that this RRSP season. And finally, to enter also into the draw, you want to direct your clients to My Client Space, where they can do contribution tools. And you guys are seeing that I've added RRSP and TFSA campaigns this season, just try to give you guys more prospecting opportunities. If you wanted to build a campaign on your own, and I'm sure all you folks here are already familiar with Web Showcase. Web Showcase is our marketing post bank, if you will. But Advice Zone houses articles where you can create or tailor your own campaign around a specific topic. So for this one that we have here in front of us, we have one related to interest rates, related to inflation, market volatility. That's probably the most clicked on throughout the year last year. And then finally, we have high interest savings account and GIC campaigns, which is done quite well this year. And, if I can pause here just for a moment, just to let you folks know what my sales report looks like. A lot of the money is going into high interest savings accounts and GICs, as well as Hilda mentioned our NASDAQ fund, which was down last year, but looking at, price to earnings ratios kind of coming back into line, maybe not as frothy as it was in the past. Maybe you're, thinking that maybe things are kind of a value buy now, right? So if that's the case, I don't see any issue with depositing your client's money, not just in high interest savings account. I mean, it's nice to put a little wedge into the high interest savings account, but take advantage of the equity markets, which have really, kind of been trading on a discount lately. So definitely keep in mind, in my report, just to let you know, my sales report does look 50% GICs and high interest savings account, but the other 50% is equities. So definitely keep in mind that you're able to do kind of a blended solution for your clients within the same contract. Now I'm going to get into the gritty of my presentation. And this is going to be really talking to those advisors that are on the call that don't have a defined investment business plan. Right. So it's the beginning of the year. We're all talking about our goals and what our resolutions are. For those of you that do it, I kind of stopped doing it. I think consistency is key. And that's really what I've been trying to focus on: consistency. And of course, trying to find a balance, whatever that balance looks like for me, may look different for you. But I think it's really important to be intentional. And I think creating a business plan as it relates to what you want your investment practice to look like in the next 10 years is super, super key. And I think after what we've been through in the last year with it, whether you want to call it a reset, whether you want to call this a recession, I don't know what the technical terms are these days, but it definitely was a moment in time where people had a little bit more time on their hands after the pandemic, and people were looking at their finances. What are they spending money on? I know I was going through my expenses and I realized I have way too many TV subscriptions. So I have like Hulu, all these things that I've never even watched. So something that I did was cleaned out all those subscriptions. So this is key to when you're trying to build your investment block. It just doesn't happen by prospecting when you're with a client, selling a life insurance policy and tacking on an investment pack, for example. It's something that you have to be very consistent with. Okay. So I'm going to kind of show you some tips and tricks, if you will, on how to start to think about building an investment practice and what that looks like 10 years from now. Right now, as I mentioned, we are seeing a lot of the cast wedge strategy in play. What that is ladder GICs. Hilda mentioned that the bond markets are looking, quite lucrative right now relative to what they look like in the past. I agree. Ladder GICs have been something I see. So if you have a client that's going to riff in the next 4 years, for example, perhaps putting that chunk of money or that designated amount of money into a GIC, whether you want to do a 1-year term, a quarter of the money in the 1 year, a quarter of the money in a 2 year, a quarter of the money in a 3 year, and finally a 4 year, just to have a nice ladder GIC. So as the money comes due, then, you're aware of the payments that are going to come in annually. So if you wanted to do that kind of nuanced sales approach, you're able to. An easier sales approach is our high interest savings account. So for the past couple months now, we have been paying nearly 4% on our HISA. So we were paying 4%. It recently dropped to 3.6. A lot of that has to do with what the 2 versus 10 yield curve looks like. So we have reduced it, but it could go up depending on the interest rates. On that point, the HISA is variable, which means if the interest rates go up, the HISA may go up in tandem. If the interest rates go down, the HISA may go down in tandem. So that's something to consider there. But the key with the HISA versus the GIC is one of them is not locked in. And I'm sure you guys can guess it's the HISA, and one of them is locked in. Okay, so we do have a market value adjustment, which discusses the opportunity for your clients to get out of the GIC before the term is complete. So that's always a possibility. We do have redeemable GICs, but for the most part, most clients stick it out for the rest of the term. Now, Hilda provided portfolios in her presentations. So a third of the portfolio, for example, looking at this pie chart in front of you, will be invested in a diversified portfolio for the sake of, example here. So that's kind of what we're pitching. So this cash wedge strategy is something I see very much in play right now. Now for long-term money meaning tax, RRSP contributions, whatever the case is, money that you're not going to use to purchase a house in the next 2 to 3 years, for example, you want to do a dollar cost averaging strategy. What that means is you're simply buying the market on a timed basis, whether it's monthly, well, it has to be monthly, amongst a 12-month period, but you're purchasing it monthly at a specific date. If the markets are down, that's okay. If the markets are up, that's also okay, because you're smoothing out the volatility by going in consistently. And again, resolutions for lots of people, this year in my friend circle has been consistency. And I think this is really what you're selling to your clients. Dollar cost averaging strategy is an autopilot strategy. It really is not timing the market, and you're smoothing out volatility over time. And yes, we could dollar cost average into the HISA and into GICs as well. So definitely reach out to your wholesaler if you're interested in that. So at the beginning of my presentation on this section, I talked about how to build your investment book. We're talking about getting investments for your clients, but you yourself as an advisor also needs kind of a plan, like a mission statement on what your goal is, maybe 5 or 10-year goal. Now, I have a really good document that I actually stole from Graeme, and I'm able to share this with you for those interested. If you really want to, get serious about building your investment block of business intentionally. Part of understanding how to do that is to have an honest conversation with yourself on where do you fall in this quadrant. So in front of us, we have active in investments, limited knowledge of investments, not really active in investments, and high investment knowledge. Okay. Depending on where you fall in this chart, your investment practice will look different. Okay, I see a lot of my top advisors or familiar names on the call. Thank you. I know you guys are very busy, but everyone here has different investment strategies. I see some folks on the call with asset under management 20 million plus, and some new names on the call. So you may not be familiar with IA investments or utilizing a different company for your investment block of business. Either case, it really helps to pinpoint where you are in this quadrant in terms of your level of comfort with investments. Now, the quadrant didn't change, but what was in each quadrant did change. So taking, for example, you're here between the limited knowledge of investments and not really active in investments. You have the option of choosing from Hilda's portfolios that she provided in her presentation. You can definitely, look at that, but that might require some active rebalancing as time progresses. Say something happens, maybe another war breaks out in, Asia or something like that. Oh, knock on wood. I hope that doesn't happen, but say something does happen, right? You may want to consider, reducing your emerging markets or Asian exposure, for example. So there would be some rebalancing required if you are looking at our pre-built portfolios. Now, if you are not looking at our pre-built portfolios and you kind of have identified yourself as an advisor, limited knowledge of investments, not really active investments, I probably want my block to be about $5 million in the next 10 years. I'm really okay with doing 2 campaigns a year. Our RRSP season, right, which is right around now. And I'll do the tax-free, after you get your tax returns, I'll do like a non-registered tax, just reinvestment tax strategy campaign. That's just 2 campaigns a year. If that's where you fall, you might want to invest in our Indexia solutions. What is our Indexia solution? So as the name suggests, Indexia is index solutions. Okay, so very, very simple. You have a basket here of index funds, and very simply you match it depending on your risk tolerance. So if you're prudent, you are going to select Indexia Prudent. If you're balanced, Indexia Balance. If you're aggressive, Indexia Aggressive. So very, very simple cookie cutter. This does have automatic rebalancing. So you as an advisor do not need to keep track of what's going on in the macro world or just what's going on in the markets. You don't need to keep track of that because IA will do the heavy lifting for you. So this is the part of the presentation where, I'm kind of wrapping up and I'm going to go into Q&A very soon. But for those of you not familiar with Evo Savings, it's super seamless. You find out, you're not really that interested in building your investment block aggressively, right? So you want a good, safe plan for your clients and yourself. You're going to identify someone as balanced. You're going to choose the Indexia Balance. You're going to log on to Evo. You are going to select Evo Balance or, moderate in this case, and build a portfolio based on that. Now, one key, and I think this is the most important marketing document we have in the financial services business, in the investment business, super, super important. If those of you in Ontario that know me, I drop off an index chart at IDC in the offices there. We have an index chart, even if you don't understand what the colors are, what the graphs are, the dots are, even if you don't understand what those nuances are, we know one thing. From the bottom left hand of the chart to the top right hand, it is going in one direction, and that slope is positive. So that means despite what goes on, daily or monthly with the markets, we know that over time, your investments is going up. It is not going down. So really the key here is be invested, stay invested. And, depending on what you're invested in, you may get a higher return or a lower return, for example, if you're holding cash treasuries or GICs. So this chart is super, super helpful. Let me know if you're interested in that chart. So just to wrap up, wanted to talk about our prestige pricing. Hilda already touched on it. $300,000 per household. I think there was a question in the chat box regarding this question. Now, this could be RESPs, RRSPs, TFSAs, and it could be anyone in one household, one address. So mother, father, nanny, grandmother, children, as long as that household has 300,000 of assets, you will receive a discount on MERs, seg funds. Now, this is also, and we're the only company who does this to my knowledge, this is also transferable to family members outside of the household. So for example, I am Filipino and Punjabi. I have a lot of big family, like a lot of family members, lots of houses. So anyone, as long as I can I qualify, I can give this to my cousin, for example, who lives in a different house in a different province with $10,000. He does not need $300,000 to start. So this is a very interesting and unique feature with us. We definitely allow you to prospect within your block of business to share the high net worth pricing. And portfolios are private, so we don't share the values of portfolios with other family members. The fee reduction on MER seg funds is about 60 basis points, depending on the fund for prestige pricing. We talked about high interest savings accounts. Our HISA is currently paying 3.9%. Our GICs are fluctuating between 5 to 10 to 15 basis points weekly as we get news, from the Fed, for example, but very, very strong rates, redeemable GICs, anything over $1 million. And we've been getting a lot of inquiries for over $1 million. It is done in-house. So there is a special quote that's generated. Reach out to your wholesaler and we will provide you with what those rates are paying. But on the flip side, folks, if anyone's looking for another campaign idea, non-registered assets at the bank, definitely bring them over, slap on a beneficiary to that account. And this business is pretty much, low-hanging fruit, I would say. Definitely advisors that love investments, the GIC opportunity these days, way too hard to say no to. So definitely keep that in mind. Regarding compensation, probably your favorite topic and probably mine, we are discontinuing June 2023. As everyone knows, DSC is out. We have F-Class, we have FEL, and we have no load options. It's very simple here at IA. Chargeback 3 means it's a 3-year period. Chargeback 5 means it's a 5-year period. So we have 5-year chargeback. So meaning free on the 6th year. You can move the money, no cost to you and your compensation, and it's free to move on the 6th year. So you want to get in touch with me to talk about comp if you're, interested in building your block of business intentionally this year. Get in touch with me or your wholesaler in your region, and we're happy to discuss in detail what our different options are. One last thing before I close off here, I wanted to talk about the BDB bonus. For those of you not familiar, it's super, super simple. For CPB, which is life insurance, 1 FYC dollar equals 1 credit. So looking at this, you need 42,000 credits to qualify for an investment bonus, and flip it to life insurance language. That's 42,000 FYC. Okay, super, super simple. And then on the investment side, $1,000 of seg funds will give you 25 credits. Okay, so very, very simple calculation here. And what are we going to pay you? We are going to pay you $500 per million of asset under management year over year. So this resets. Okay, so another $500 on asset under management. If you hit this threshold, which is 126,000 FYC, there are a couple people at IDC who have done that last year. You get $700 per million of asset under management. And the kicker to this, which I haven't seen any other company do, is IA will also pay you on top of that 1.5% for all of your in-force life insurance premiums. So if you've been in the business a long time selling IA, for example, UL, we're going to pay you 1.5% on all your in-force life insurance premium. That is huge. So if you're not familiar with our business development program, please get in touch with your director. We're happy to expand on exactly how to qualify for this. If you have any questions, I'm going to leave it at this. Here's my contact information and my internal wholesaler, Fraser. We're both here and able and happy to assist you. So let us know if you have any questions. But again, just wanted to thank you so much for your time and your consistent production throughout the years. I know last year was a difficult one, but IDC really crushed it. So thanks so much for that. And that's it for me.
Because in the chat box, someone asked about the DSC. As a company, we do not have any, guideline as to what will happen when we finally ban DSC in June. But our guess is that, any existing DSC contract will still be in place. So, we'll have to, wait for head office, any guidance and instructions. Would you like to take this one?
Yeah. Yeah, I'll let you take this one, Hilda.
Okay, so another question about front-end load. I have clients wanting front-end load monthly contributions, but IA does not pay us commission when we do this. IA is the only company who does not pay us. Why? Okay, so with front-end load, no company pays you any commission with front-end load unless you negotiate with your clients and make a commission out of it. Because with front-end load, you can do 0 to 5%, but we hardly see anyone charging a commission on front-end load. So if that answers your question.
Well, yeah, that's a lot of questions there. Graeme, do you have any comments or questions?
Well,
or
if there's any questions here, I guess, that you want to take offline and follow up with the people who've asked them afterwards, that would be great. We're almost at the end now. I think the one thing that the index chart definitely seems to have resonated with people. And I know that in my career to date, that's been the one thing that really is, it's non-biased. It does, if there's no badge on it, even better kind of thing, right? And from a historical point of view, we know what's going to happen. And as relate to the comments that we made in the beginning of the presentation, it's probably the best time now to be actually getting back in and riding the wave for the next 5-10 years or so. The opportunity is there. You've got the product. I think something that really jumps out there is the high net worth offering that you have in the householding function. That's huge. Every advisor that we speak to consistently questions cost. I mean, your retail people are getting bombarded on the television with adverts and print media and so on about the cost to invest. So, as a starting point to bring assets together to conglomerate everything in the one spot, why would you not do that, right? Why have small accounts or other manufacturers when you can bring it all together and get the reduced pricing? The index funds you mentioned, I'm a big fan of trying to keep things as simple as possible. I think many clients, that's what the client wants. They want a simple solution to what they're asking for. They don't want to be confused with the industry jargon that we use and big words and all this terminology. So the simpler the better, the cheaper the better, and obviously will lead to a better result in the future. But I would encourage everybody. We had a great attendance today. Thanks to everybody for taking the time out of their schedule to join us. I'm really happy to see that. I know IE is growing and growing on the platform all the time. I've been an advocate. I think IE truly is a one-stop shop for people building business that just wants to get everything together and work towards critical mass in the practice for the future. So I know you're both keen to speak to advisors and keen to engage and meet and do the face-to-face that we have all missed so much. So to everybody on the line, please take the opportunity to reach out and spend the individual time, take an hour and really jump into depth about this stuff. And I'm sure that will lead to success in the year running forward and the years to come. So we're right on time right now. Again, thanks to everybody and have a great day. Thanks to you both.
Thanks so much, Graeme.
Thank you. Bye.